This is Financially Fit Business with Ruth King.
Here you discover ideas, tactics, news, and information that matters to the health of your business or your clients' businesses. I'm your host, Ruth King. Here's how we will help you increase the financial fitness of your business today. Subtle changes in P&L and balance sheet trends mean a lot. It's best to pay attention to these small changes and resolve them before they become major cash flow, productivity, or profitability problems. In the last episodes, I covered little changes in the overall profit and loss trends, changes in gross margin, and changes in productivity. I covered little changes in the balance sheet, current ratio, asset test, accounts receivable to accounts payable, and usage ratios. In this episode, I covered the balance sheet debt to equity ratios. Let's get started. Debt to equity is probably one of my least favorite and least paid attention to ratios. Long-term debt to equity, I pay attention to a lot. The reason that I don't pay a whole lot of attention to debt to equity is it really and truly depends upon jobs. It depends upon the work that you're doing. It depends upon, if you start really big jobs or really big projects, the debt to equity ratio usually goes up pretty much because you're buying materials, you're buying inventory, you're buying stuff, and you're paying for it in 30 days. So guess what? Debt goes up. The equity, the long-term debt to equity is really important because that's how much the company has saddled itself with debt on a long-term basis, i.e. debt that's over a year in length. Debt to equity covers all the debt, both, current liabilities and long-term liabilities, current liabilities being things that have to get paid within a year. And the long-term liabilities is, things that you've got, car notes and things like that, which are, 3, 4, 5, sometimes 10, 15 years, depending upon whether it's equipment or potentially SBA financing or something along those lines. So pay attention more so to long-term debt to equity. I find that most small businesses, long-term debt to equity should be decreasing or zero. There's a lot of companies I work with where the long-term debt to equity is zero. The companies just don't have any long-term debt. They pay cash for everything, which is fine. That is a total company owner decision. It's not a decision for me to make. It's not a decision for you if you're a CPA or bookkeeper to make. It is the decision of a company owner that says, I want no long-term debt. So they've got enough money to pay for whatever they need from an asset perspective, so that they can still operate and pay for whatever assets they need out of savings and pay themselves back rather than necessarily a bank. So that's their choice. A lot of times in many industries, I also like to see long-term debt to equity be less than 1. However, that goes industry by industry in terms of how much long-term debt there usually is in a particular industry. So let's take the debt to equity first. This is all debt, current liabilities, long-term liabilities, all debt that the company has, and divide that by equity, which is, the net worth of the company. So if equity is negative, i.e. the company has been in trouble for a period of time, what happens is the company gets more and more and more profitable sales and equity keeps increasing and gets less and less and less negative. This debt to equity has a tendency to get very, very, very negative because it's a very little negative number that we're dividing by and a normal debt number. So once the company becomes more and more and more profitable and the equity at that point flips to a positive number, it's still a very, very positive, very, very small positive number. And the number is huge from a positive perspective. So if you're working with companies or if you've got a company who's in this particular situation and you're getting more and more positive with respect to equity, you're going to see large negatives to large positive to something that eventually evens out as the company stays profitable and continues to stay profitable. So hopefully that's not the case with the company that you have or that you're working with. But I just wanted to bring that up just in case you saw that type of thing. I didn't, want it to be, something that you would freak out over. Let's look at it from a perspective of the debt to equity ratio under normal situations, i.e., you're not you're not buying things for large jobs or anything else along those lines. This ratio overall should then be fairly consistent, both from a debt, current liability situation to an equity situation. In fact, it should probably be going down because as the company continues its profitability, equity gets larger and larger and larger, and this will eventually get to a smaller number and actually just even out. All right. Long-term debt to equity would follow this pattern, or it would be zero, depending upon which way the company goes. The interesting part about this ratio is that if you take on a huge amount of debt, so for example, let's say the company buys another company and they buy it using debt, i.e., they get a loan or whatever else it is. These two numbers have a tendency to just go way, way high. And if you see that, it's like, okay, what happened? There was some sort of event that made the debt to equity and long-term debt to equity increase significantly or decrease significantly, one of the two. I see this number decrease significantly when large retainage checks get received from a construction standpoint. The long-term debt to equity doesn't change, but the debt to equity itself does change. So it's just something to think about in terms of, okay, if there's shocks to the system, i.e., you're expecting this very nice trend line or this very flat long-term debt to equity or zero, and all of a sudden it goes, whoo, it shoots up. It's like something happened. Um, and if it's not something that like the company bought a huge asset using debt, or the company bought another company, or there's, company owner took money out of the business, or, something to make this happen, then you have to figure out what's going on and why this happened. And that's something you're just going to have to dig. Any small shocks to a number that is generally consistent or a number that is generally flat or zero, you need to find out what happened. And sometimes there's a really, really good explanations for it. And that's why then the debt to equity at that point should start going down again. Okay, we'll be right back. Thanks for listening to the Financially Fit Business Podcast.
Financial advisory services are the key to the longevity of the accounting profession. If you want to get started providing advisory services or want a review of a finance course you took in college, Ruth King's manual, Understanding Financial Trends Analysis, might be your first step. This manual gives you the information you need to help your clients with their financial statements. A great start or addition to your financial advisory practice. You help them with clarity on their business's financial health, the ability to spot impending issues and resolve them before they become a major crisis, less stress and sleepless nights worrying about the financial part of their business. Your Financial Statement Trends Analysis Manual is the reference guide. What do you want in your financial advisory services practice? Click on the link below for more information and to order.
We're back. Thanks for listening to the Financially Fit Business Podcast. Before the break, we were talking about shocks to the debt to equity and long-term debt to equity ratios. And then they generally happen because of purchases of assets for debt, or purchases of businesses for debt, or basically getting a huge retainage check in the door. Things that are shocks to the normalcy and the normal operating things of a business. So if those are the case, then figure out why. All right. These two numbers, I see debt to equity going up and down and up and down and up and down. I see long-term debt to equity going down significantly, but very, very, very slowly as the debt gets paid back. Remember, the trailing data is a year's worth of data, a month at a time. So how much of the principal got repaid in a particular year? It goes down, slowly, 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 slowly. And it's interesting because what has happened is the debt to equity fluctuates so much depending upon what's going on with respect to the business. And that's why I don't put a whole lot of emphasis on debt to equity. It's probably the least of all the trailing data and all the data graphs that I follow. I just want to see what it looks like, obviously, and so would you. But the reality of it is that so much stuff happens, on a daily, weekly, monthly basis to make that particular ratio potentially go up and down depending upon purchases for the business. It's just the long-term debt to equity that I pay a lot of attention to. For the simple reason is that you don't want to saddle the company with too much long-term debt if you can avoid it. It's just, you sleep better at night. You don't have, all these loan payments to make and everything along those lines. And I had one of my clients had enough savings in a savings account, and he needed 5 trucks. So we looked at it, and we looked at it from a bank perspective, i.e., banks were offering him 1% interest rates, which was, really, really good. They really wanted his business, so that's why they did that. And we ran the numbers for that 1% interest rate and how much we had to generate to pay for the trucks and everything along those lines. And then we looked at it in terms of taking the money out of savings. And the two numbers were there, and he still opted to take it out of savings because that was his choice to do it. But the interesting thing that he did, which was the right thing to do, is he took the money to buy the trucks out of savings. And instead of paying the bank back their interest payments and their loan payments, he paid his savings account back the loan payments for taking that money out. So he became his own bank at that particular situation. And so nothing happened to the debt to equity ratio. The long-term debt to equity ratio still remained 0. And there was nothing for the purchase of those trucks. The only thing that happened was the current ratio went down because we were taking current assets and turning them into fixed or long-term assets. So it's an interesting conundrum and question that your clients might ask you if you're a CPA listening to this. Should I buy or should I, take out, should I take out a loan or lease? That's generally a question with purchases of vehicles. But also, should I use savings versus should I, use debt? And you can run the numbers both ways and present both to your client, or you can, and the client has to decide, all right, I'm going to use cash or I'm going to take a loan out from the bank. This decision actually fit very well with this owner because he was very debt averse and he had no long-term debt to equity anyway. I was not surprised when he chose to take the money out of savings to pay for the trucks and pay himself back, which he did. All right. So let's get back into the debt to equity and long-term debt to equity. So if you know for a matter of fact that no additional debt was incurred in a particular year, the long-term debt to equity should be going down. If it's not, find out what's going on. And the other thing to remember is that sometimes, again, like we did with the debt to equity, the long-term debt to equity can get negative and very negative as the company, which had been in trouble with negative equity, turns into positive equity. And, it gets less and less and less negative. It gets more, and the graph gets more lower and lower and lower. And all of a sudden the equity gets positive and boom, it shoots straight up. And then it will eventually go back, hopefully to 0. Okay. Now, the other thing that you need to look at is the equity component, because sometimes if the company has been losing money for a period of time, then this equity is going down and down and down and down, which means that your debt to equity ratio is going up as a result of less profitable sales, let's put it that way, and less retained earnings and things along those lines. If this is the case, you should see debt to equity going up and long-term debt to equity going up instead of going down. This should be a warning sign to you that the company is less profitable, its equity is going down, And as a result, the debt to equity is going up and the long-term debt to equity is going up. So those are the things that you've got to really pay attention to when you're looking at this. And that graph going up will be very subtle because the debt to equity less and less and less. It's not like a boom, like purchasing a whole bunch of material or purchasing a business for debt. It's very, very subtle. So if you see on the P&L graphs, your trailing net operating profit going down, you should see the debt to equity going up at the same time. So just be careful and make sure that that's not happening, because the last thing you want is no equity or negative equity and the graphs go negative. Not a good thing. So thank you for joining us. Choose one thing that you discovered and implement it in your business. These ideas, tactics, and strategies help you make more money, have more free time, and give back. If you like today's program, spread the word. Please review this podcast on any device you're listening to it on. Help a business owner improve the health of his company. For comments or questions, call me at 770-729-8000 or email rking@financiallyfit.business. Thanks for listening. Have a great and profitable day.